One of the most common questions I get from investors is which one is the better stock to buy, Apple or Microsoft? So in this video, I'll answer that question. I'll compare these two tech giants across revenue growth, profit margins, and return on invested capital. I'll share with you my discounted cash flow calculations, which calculates a fair value for these stocks and compares to current market prices to see if they're undervalued. I'll do all that in this relatively short video, so let's get right into it after a brief message from my sponsor.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I wanted to start by comparing these two on revenue growth over the previous decade. And what stands out is the slowdown in Apple's revenue growth since 2022, when it generated $394 billion in revenue, and that's increased only to $409 billion. So the last few years, Apple's revenue growth has slowed down considerably. Meanwhile, Microsoft has continued and accelerated its revenue growth. Overall, Microsoft's revenue has increased from $94 billion in 2015 to $282 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 12.3%. That's nearly double the rate of Apple's compounded annual revenue growth in that same time period of 6.1%. The next metric I wanted to compare these two on is the operating profit margin. And interestingly, they started in 2015 with Apple having the better margins, but those have changed. Microsoft has continued expanding its operating profit margins from the 29% level in 2015 to 45.6% in the most recent trailing 12-month period. It's no wonder why Microsoft CEO Satya Nadella has been given so much credit for such excellent performance at Microsoft over the previous decade. Apple's margins have been more volatile and have stayed relatively flat over the previous decade. From 30.5% in 2015, they fell to 24% before rebounding to 32%. In this time, Apple's services business has expanded meaningfully, and Apple's services segment generates twice the gross profit margins compared to its hardware segment. So even despite that mix shift in business, Apple's margins have stayed relatively flat. The next metric I wanted to compare these two on is the return on invested capital. This is where Apple outshines Microsoft, and the only metric that Apple outshines Microsoft in the ones we considered. Apple's ROIC has increased from 19.5% to 34%. Again, one of the primary reasons is the expansion of the services segment, which doesn't require that much expansion in capital expenditure. Furthermore, Apple outsources nearly all of its manufacturing, and that allows the business to generate a better return on capital because that capital is not being invested by Apple, it's being invested by companies like Taiwan Semiconductor Manufacturing, which is investing almost $40 billion every year in upgrading and maintaining its manufacturing facilities. Apple would have had to spend that money if Apple was manufacturing in-house. So that's allowed the company's margins to improve. Meanwhile, Microsoft's margins have been more volatile. The primary reason is because Microsoft has invested aggressively in these last 5 years in laying out capital. First of all, they made that huge acquisition of Activision Blizzard that cost the company tens of billions of dollars. Additionally, Microsoft is spending upwards of $80 billion this year on capital expenditures to build their capabilities in artificial intelligence. So the company has increased that from last year, where they spent roughly $60 billion. So those large investments in artificial intelligence is weighing on the company's ROIC because those investments are long lasting, right? They bring back the returns over many, many years. And so the initial investments weigh down the profitability, the ROIC, and then over future periods, they get to reap the benefits of those investments. So now that we looked at the important financial metrics, let's look at valuation. So I calculated a fair value for Apple stock at $209 per share. And this is higher from where I had this fair value calculation a week ago as I updated my spreadsheet today. The current market price is 236, so Apple stock looks slightly overvalued when I apply a margin of safety comparing the market price to my intrinsic value. For Microsoft, additionally, I calculated the intrinsic value per share at 461, current market price at 499. When I apply a margin of safety, Microsoft stock looks fairly valued based on my DCF formula. Now, when I look at the forward price to earnings ratio, by the way, I'm getting all of these charts from fiscal.ai, my preferred data provider. There's a link in the description. If you're interested, you'll get a discount using my link. Apple is trading at a forward PE of 31, while Microsoft is trading at a forward PE of 32. So basically equally valued here in terms of the forward price to earnings ratios. And looking at revenue growth, where Microsoft nearly doubled Apple's revenue growth rates and the better operating profit margins, Microsoft, I believe, deserves a more premium valuation compared to Apple. And if I had to pick between these two stocks today, I would pick Microsoft instead of Apple as the better stock to buy right now.
Hey everyone, I'm excited to announce that my book, Make Money Buying and Selling Stocks, a 6-step framework for evaluating publicly traded companies, is finally available for sale. Unlock the power of intelligent investing with my 6-step investing framework. It's a proven system designed by a university professor and a chartered financial analyst. Frustrated by the lack of frameworks that met my needs and high standards, I developed this comprehensive guide to help investors at all levels make confident and informed decisions. In this book, you learn how to assess opportunities, manage risk, and build a portfolio that works for you. No investor should dive into the market without a solid strategy, and this step-by-step framework provides you the roadmap you need. Whether you're just starting out or looking to refine your approach, this guide will empower you to take control of your financial future. I've added the link in the description below.